Hello, and thank you for joining us for our presentation today on being the bank with your retirement account. And this presentation is going to cover a couple of different types of private lending, as well as how an IRA can actually be a borrower for investments. So again, thank you for joining us. My name is Larissa Greene, and I will take questions throughout the presentation. Please just go ahead and type them into the chat box, and I will address them as we go. We like to keep everybody muted, so it's a nice, clean recording so that those people that registered and cannot attend can listen with ease later on. I've been with Advanta IRA for 10 years now, and I work in education and business development. Basically, what I do is a lot of networking for the company, as well as educational events like this one. And if you've joined us for our Pitch, Promote, and Prosper event that is every other Friday, you know we do a lot of networking on behalf of Advanta. And when we can, we join live groups. We have groups at our office. And again, I hope to start that soon. But in the meantime, we continue to bring you webinars every week. There's a few a week, and then our Pitch, Promote, and Prosper event is every other Friday. So the next one will be June 18th. I just want to let everybody know that, because you can go to advantaira.com/events and check out any of our upcoming events in that way. My contact information is here on the screen, so if you have questions or something you'd like to go over in more detail, please feel free to reach out to me. I'm also happy to provide these slides to you. Again, just send me a quick email and let me know that you're interested in having the slides, and I will send them over to you. So we're going to talk today about the rules and how they work around private lending in a retirement account, but something that we don't do is give investment, legal, or tax advice. So that's very important. And if you have a question, you're not sure if it falls into one of those three categories, please feel free to ask it, and I will let you know if I can't answer it, but I might be able to refer you to a professional that can. The information that we share is based on the rules, basically, for investing through a self-directed retirement account, and we can go over that and structures of investments that are allowed within the account. And sometimes we talk as well about things that might be considered in a gray area, and of course at that time it's a great opportunity for you to involve your professional team, like your accountant or attorney, for advice on those types of investments. When I go through the presentation, a lot of times it feels a little bit like we're saying you can't do this, you can't do that. But, you know, our goal really is to educate you so that you understand outside of these things, the sky is just about the limit. But what I really want you to take away from this presentation is that any IRA or former employer plan qualifies for self-directing. You choose the investment. We don't sell any investments at all. And then all expenses for that investment are paid by the IRA, and any income is received by the IRA, and that's very, very important. So here's our agenda for today, and like I said, as I go through this, if you have questions, please feel free to type them into the chat box. I am going to cover information about self-directed IRAs, the asset classes that we see, the accounts that we hold, but I'm going to go over that stuff very quickly. You know, our primary focus today is private lending, and I want to go over some case studies too to really help you understand how private lending works in a retirement account, so we won't spend too much time on the front end of this presentation. So a little bit about Advanta. We've been in business for probably about 17 years now. We've always only held qualified funds, meaning retirement accounts, and I'll go over what that means in just a second. We are based out of Largo, or the Tampa Bay area of Florida, and we also have an office in Atlanta, Georgia. But our corporate headquarters, so to speak, is here in the Tampa Bay area, which is where I am also located. Our Georgia office handles education and marketing, but we can work with people nationwide and even worldwide. So if you have a US-based retirement account, you can certainly self-direct that, and that is something that we can help you with regardless of your address. So please feel free to let me know, where you're located, what you're thinking about doing, and we can help you with that. Something that we do a little bit different than our competitors, we have a system in place called an account management system, where every individual that has an account with us is assigned an account manager with Advanta IRA, so that they have that one point of contact for their account. So you can basically reach out to that individual. You have their email address, their direct number for any questions you have regarding your IRA account. So did we receive a transfer? How do you make an investment? How can you make an annual contribution? Do you have questions on your fees? And it just seems to make the whole experience overall very easy and very friendly for our clients. And we've been doing that for a lot of years now, and I think it has made all the difference as far as customer service is concerned. We have, and actually I do need to change this slide because we have around 1.8 billion in assets under management. We have a little over 8,000 clients, and again, they're nationwide, and we even have a few worldwide. I mentioned the events already, but just keep in mind that everything is recorded. So even for this presentation, if you'd like to go back and check it out again, you certainly are welcome to in our video library, or go to YouTube, search Advanta IRA, and it will be saved there. You will also receive a copy of it to your email inbox because you did register for it. So you'll have the opportunity to share it or review it, whatever you would like to do. Again, we have networking events every other Friday. Our lunch and learns are on hold if you're local to one of our offices, but we hope to be looking at those again, hopefully sometime in the future. And, you know, we have blog articles. We really try to keep our content going and, you know, relevant to what's going on for IRAs and retirement accounts in general. So please do check all of that stuff out. So we're going to talk about what a self-directed IRA is. And again, I'm going to go through this very quickly, but a lot of times people will tell us, well, I do have a self-directed IRA. It's with a brokerage firm. I'm allowed to choose the stocks, bonds, and mutual funds I invest in. But our definition of a self-directed IRA is much different. And if you're a client of ours, you already know, but we actually don't hold anything publicly traded at all. The investments that we hold are going to be specifically private investments. And those investments are of your choosing. So we don't say invest in this or that. We say, here's the different asset classes you can invest in, or rather what you can't invest in. Now it's up to you to go and find those investments that you feel comfortable with and grow your IRA or your 401k in whatever it is that you know best. And the IRS regulations allow for a very broad spectrum on the types of investments. And that's why a lot of times we teach on what you can't do rather than what you can do, because what you can do is a very long list that's ever growing. Really, as people get creative, our clients are very entrepreneurial. They come to us with ideas. Will this work? Can I structure it in such a way that I can have this in my retirement account? And it is actually less than 4% of all retirement accounts that are truly self-directed based on our definition of self-directed IRAs. So the different types of plans are listed for you here, and I always feel like this is important to cover at least briefly because many people think that it has to be a Roth IRA that's self-directed. I'm really not sure where that comes from, but that tends to be something I get asked pretty regularly as well. I don't have a Roth IRA. I don't want to pay the taxes and convert a traditional IRA over to a Roth IRA. So you know, I can't self-direct it. And actually, if it ends in IRA, it can be self-directed. Any former employer plan, and you know, we put emphasis on former because if you're still participating in the plan, you're a current employee, it's going to be based on whether or not the employer plan or the plan administrator allows you to move those funds. But certainly if it is a former employer's plan, you are allowed to move those funds. We also have up here education savings accounts and health savings accounts, and the rules for self-directing those accounts are going to be exactly the same as an IRA, and so we can hold those as well. And then of course solo 401ks, and those are plans, you know, sort of dedicated towards the self-employed individual. They have a lot of great benefits and they can be self-directed as well. So that just kind of covers the different types of plans, and you can see here outside of solo 401ks, we also have 2 other IRAs that are employer-based, so SEPs and Simples, and we can help you with those as well. Again, if you have questions on any of this, please let me know. I did include the contribution limits here, and I apologize because this slide is for 2020, which you cannot no longer make your 2020 contributions. But just to give you an idea, they haven't really changed much. Traditional and Roth are going to be the same, 6,000 or 7,000 if you're over the age of 50. You had some increases on the employer-based plans. The SEP and the 401k are going to be 58,000 for 2021. But this will kind of just give you an idea of where the limits are, because sometimes people say to me, well, I have, $15,000 I want to dump into a Roth IRA. And unfortunately, that won't work based on the contribution limits. But here's the information to sort of get you started. And again, please feel free to reach out to me and we can go over 2021 in more depth. So I just want to talk very quickly about the different asset classes or different investments that you can make within a self-directed IRA. And remember that this list doesn't include every investment or every asset class that you can hold. And the reason is because that list doesn't really exist. It was not provided by the IRS. What they've done instead is give us a list of things that you can't do. And then outside of that list, just about the sky's the limit. So real estate, of course, is the number one investment we see through a self-directed IRA. It makes up for about 1/3 of the assets that we hold, which is a large amount considering that no other asset class comes near that 1/3. So it can be single family homes, whether you're buying and holding it for a long-term rental. It can be short-term rentals. We see rehab projects. It can be condos and mobile homes and mobile home parks. People buy property through tax deed auctions, real estate investment trusts, again, as long as they are privately held, syndications and private placements, commercial property, whether it's offices, for example, it could be senior housing, multifamily. There's a lot of options in real estate that we see on a regular basis. I probably have conversations with individuals on investing in real estate, I would say 80% of the time. So 80% of the phone calls that I have are on real estate in an IRA. Now, that's not the only asset class that we hold, but that is the majority of what we are asked about. I had a question pop up here on the type of IRAs that you can self-direct, and the question was regarding a rollover IRA. A rollover IRA is just a traditional IRA. It's a fancy term that means it probably was an employer plan at one point and rolled over to a traditional IRA, and certainly that can be self-directed. The rollover title of that IRA is just something custodians use to sort of qualify it as where it came from originally. So yes, absolutely, you can self-direct that. Here's the paper assets of self-directing your retirement accounts. Of course, mortgages, tax liens, I mentioned tax deeds, unsecured notes, debenture notes, option contracts, assignments, joint ventures, accounts receivable. All of this stuff is allowed within a self-directed account, and we're going to go over in more detail many of these paper assets in just a minute. The other truly alternative or unique investments are going to be listed here on the slide in front of you. And a lot of times people will say, well, that does sound very unique. Why would people make this investment? And, the honest answer is most people that are self-directing their retirement account are making investments in what they know best. So, farm animals, things like cattle, alpaca, racehorses, that might not be something that I have a lot of knowledge in, but many of our clients do. And so that's where they prefer to grow their retirement account. The great thing about a self-directed IRA is that you're really growing your retirement account in what you know best. So I also have up here movie projects, and we did see a capital raise for a movie project several years ago. It was located here in the Tampa Bay area. And we had a client call us and say, hey, I really want to do this. Can I do this with retirement funds? And so, we told them yes. And because they learned about it, they shared it with others who wanted to make the same investment. And so there was a few IRAs invested into a local movie project. We also see precious metals, things like gold and silver bars and coins, bullion. It can be invested, into that tangible gold and silver rather than something that you see market based, and then it's just held by a third party depository. We see equipment leasing. It can be large format printers. We see ATM machines. We've seen things like farm equipment. So really kind of runs all over the board as far as different unique investments. Forex accounts, and if you're not familiar, that's foreign currency trading, and we do see a lot of that. Those types of platforms don't want to hold the retirement account, but they certainly do allow the retirement account to hold a profile on their platform and do the trading, and then we in turn do the IRS reporting, which is probably what they don't really want to be involved in, and so that would be our role there. We see a lot of private stock, things like local banks and breweries and restaurants, commodities, and of course oil and gas. So those are some of the more unique investments we see in a retirement account. Moving money is really easy. It's just a matter of letting us know where the funds are going to come over to us from, and then we help you with a trustee to trustee transfer if it's coming from an IRA. It would be a direct rollover if it's coming from an employer plan over to your IRA with Advanta directly, or an indirect rollover if a distribution was involved in any of those types of accounts prior to coming over to Advanta. You should be aware that some of these have no reporting, so transfer, trustee to trustee, there's no reporting involved, and it is handled by Advanta directly with your current custodian. A direct rollover is something that you actually do initiate with your old employer's plan. They have you complete some forms. There is IRS reporting involved, but we will also do the IRS reporting that shows this is a non-taxable event. And then in the case of an indirect rollover, when you take a distribution, you do have some rules that you want to make sure you're abiding by. You have 60 days to roll it over, redeposit it to a retirement account. There is IRS reporting done on both ends. And so if you're looking at something like that, you just want to be aware of what the rules are and the restrictions. So let's talk for a second about the rules for making alternative investments. And like I said earlier, there really isn't a list of things that you can do, but instead there's a list of things that you can't do. And so you definitely want to familiarize yourself with these rules. And when you're looking at an investment, reach out to us and let us know, hey, I'm thinking about this. Will this work within the rules? Where can I go to read more? And we can help you with that. But basically, the IRS doesn't allow two types of investments. So, and remember, I said, the list of things allowed just is ever growing. But for things that are considered prohibited, there's only two: life insurance and collectibles. So those two asset classes are not allowed in your IRA. And when we look at collectibles, we're talking about things like antiques, alcohol, artwork, stamps, some coins. Now, remember, I said gold and silver would be okay, but if you're talking about a coin where the value is considered based on whether it's rare or antique, then it's going to be something that is not allowed in your retirement account. So keep that in mind. I think the biggest one that I get asked about is going to be antique cars. A lot of times people are asking me about antique collectible cars. Are those allowed in your retirement account? The answer is no. There's a lot of reasons probably that the IRS outlined these two asset classes as prohibited, but they are prohibited, so keep that in mind. The next thing to understand is who is considered a disqualified person. And so when you're looking at disqualified persons in your retirement account, it's going to be people up and down your lineal tree. And so what the IRS says is you cannot transact with these people in your IRA. It would be considered prohibited. And there are some things that go along with that. There's a rule where basically the IRS says the IRA holder or these disqualified persons cannot have a current benefit from the investment, that you want to make sure that you're not transacting, trading, doing business with, investing with these disqualified persons when it comes to your IRA. And I have on the next slide, we'll go into a little more detail on that. The next thing here that you need to be aware of is when a tax does apply to the IRA. And I think people are always surprised about this because technically the IRA is a tax-deferred or tax-free vehicle when it comes to investing. But there are two instances when a tax would apply to the retirement account. We're going to talk about that today, but ultimately your CPA is the very best person to give you advice on these two times when the tax applies. So the tax is referred to as unrelated business income tax, and it does apply if you are running a business out of your IRA So typically we're going to see passive investments, things like long-term rentals, for example, or when you lend money and you have interest income coming back to an IRA. But at some point, if you make an investment where there's business income being returned to the IRA, that is going to trigger this UBIT. Now, we're not going to make a determination as to whether or not it applies, but in instances where you might be running a business through your IRA, it doesn't make it prohibited. It just means that you have to file an additional tax form and have the IRA pay those taxes on an annual basis. And again, if you're looking at making an investment where it could be considered a business in the IRA, that's when you want to consult your CPA. The next time unrelated business income tax is triggered is because of unrelated debt financed income. So what that means is that, and we're going to talk about this in more detail, but if the IRA borrows money to make an investment, it is going to trigger unrelated business income tax because of the debt financing. And I have an example of that for you. And so we'll go through that step by step so you can see what that looks like. But keeping in mind again that if UBIT applies, it doesn't make that investment prohibited. It just means that there is an additional tax form to file. You can see it listed here, 990T. So there's some calculations for you. You file the 990T and the the IRA does pay that tax. I had a question pop up here. Long-term rentals have, do long-term rentals have to pay UBIT? They don't typically. You're not going to see, so if you have something that's really considered passive income, so, if you have, rental property and you put, a tenant in and you have a year-long lease, you're not going to have something really there that triggers UBIT. Now, if you purchase that property and use debt financing to purchase the property, that would trigger UBIT in that scenario. So here is the information on who is considered disqualified, and you can see on our little picture here that it would be the IRA holder is considered a disqualified person, the IRA holder's spouse, parents, grandparents, children, grandchildren, and any spouses or business entities of those. And that is really important because a lot of times people say, well, if I can't lend money to my daughter, can I lend money to my daughter's husband? The answer is no, because those individuals married to disqualified persons are also considered disqualified. Also, that includes any businesses owned or related to those disqualified individuals. And again, that's very important. So let's start with the IRA holder. How can the IRA holder be disqualified? Well, the IRA can make its own investments. And I always like to tell people, think of your IRA as your business partner. And so your business partner is making investments basically at arm's length from you. So you can't lend money to yourself, for example. You can't invest into your own business. You can't buy a rental property personally and have your IRA do the rehab work on that. Those examples will not work because you're considered a disqualified person and you cannot have any current benefit from your IRA. That it goes along with the other disqualified persons listed here, your spouse, your parents and grandparents, your children and grandchildren, and again, those business entities that they might be related to. So if your son, for example, owns a construction company and your IRA buys a rental property, but it needs rehabbing, and you say, okay, well, I'm going to hire my son to do the rehab work, unfortunately, that is considered prohibited. So you want to be aware of the rules and how they work and how those rules work within the IRA, and be sure to steer clear of those individuals considered disqualified. I had a question pop up here. Could you lend to your child's fiance before they are married? The answer to that is a very gray area, and here's why. If there is a benefit to your child for that loan, then it's going to be expressly prohibited, because remember, there can't be a current benefit to a disqualified person. If the loan, let's say, is for investment purposes strictly and there's no current benefit, remember that it would be your burden to bear to prove there's no benefit, for one, and two, in the instant they get married, it's considered disqualified. So I would highly recommend speaking with a CPA or an attorney familiar with the ERISA law if you're going to make an investment like that, to be sure that that investment would be something that the IRS would be okay with and that it is structured properly, because it is definitely a very gray area. I had another question pop up about an annuity and an IRA. A lot of IRAs have annuities. We don't hold annuities, so that's not something that we will hold. We only do the alternative investment. If you have more questions on disqualified persons, please feel free to let me know. But this kind of just gives you an idea of the things that you really need to steer clear of. And you want to make sure that you're not going around the rules to make an investment, because going around the rules basically is against the rules. And so if you said, okay, well, I'm going to lend money to my friend's LLC who's going to lend money to my son or daughter, that would still be considered prohibited, because ultimately the IRS is looking at the end game there and what you're trying to accomplish. So again, just to go back over it and reiterate, no selling, exchanging, or leasing property from a disqualified person or to a disqualified person. Lending money or extending credit, that's a good one. You cannot extend your personal credit or give a personal guarantee for your IRA. The IRS does not allow it, and we'll talk about that when we talk about the IRA borrowing for an investment. No furnishing goods, services, or facilities. Again, for any disqualified person, and that includes businesses and spouses of those disqualified persons up and down your lineal tree. Big key points with real estate: no self-dealing and no personal use. So you can't buy a second home or a vacation home with IRA money. The investment has to be for investment purposes and leased or transacted with third-party individuals only. So if there are no more questions on that section of our presentation, we're going to go into private lending. And I thank everybody who is aware of the rules for just bearing with me for a few minutes there, because we do like to cover that for those individuals that are new to self-direction. Now we're going to talk about private lending, and we'll go into the basics. And then from there, I'm going to go over some case studies that I think will really help you understand the rules for making investments and how the process actually works when you are lending money out of your IRA or borrowing with your IRA. So there are a lot of different types of private lending, and at Advanta we've probably seen it all. So we're going to talk about the most common types or common structures that we see. There are people who are doing traditional mortgage lending out of their retirement account, meaning not necessarily 1-year terms, but sometimes 15 years or even 30 years. And I think that always surprises people, but it certainly can be done with a retirement account. We do see that on occasion, but it's more typical that we see, anywhere from 1 to 5 years on the length of the loans from a retirement account. That's a little more typical, but it doesn't mean, that's the norm. We see short-term transactional funding. So there's a lot of stuff going on where maybe it's kind of like a bridge loan, or even something as simple as, somebody's closing on a property. They need a loan prior to getting their next loan in place. Maybe the property needs to be rehabbed before there's an institutional loan put on the property. And so there's that short-term transactional funding. I've even seen people lend at small amounts of money for earnest money deposits. And so there's really no right or wrong way to do it. It's completely between the lender and the borrower. And so when people come to us and say, well, this is what I'm going to lend, it can be anywhere from $1,500 all the way up to $1 million. And again, it's up to the IRA holder and the borrower to create and agree upon those terms. We do see unsecured notes. I think that surprises people a lot, but IRAs can lend money unsecured. It is up to the IRA holder to do their due diligence on those and on all investments, really. And so if they feel comfortable with an unsecured note, they can certainly do that. And let me back up to the mortgages for just a second, because that could be a first position, a second position, a third position, and on and on. And again, it is completely up to the IRA holder to make those decisions and feel comfortable in the investment. I also have up here equity participation or joint venturing, and I have an example of that. We'll talk about that, but if you're not familiar, it's basically when you lend money, you might have some interest rate being paid back to the IRA, but typically you're going to see a percentage of the upside either instead or in addition to the percentage being paid on the loan. So, you might lend at 5%, for example, and then receive a third of the profits when the property is sold. And so we do see that a lot as well. We also see notes secured by other types of assets outside of real estate. And, I have an example of that. We'll go over that. And there's some important things that you need to be aware of when you're lending money that is secured by assets other than real estate. So we'll talk about all of that. So establishing the note terms. So, the IRS has not given us rules for private lending. They haven't said you have to do it this way. You have to receive this amount back. As far as interest rate is concerned, it can only be a 15-year loan. None of that exists in IRS rules. So those terms are completely established by the IRA holder and agreed upon by the borrower. So it's going to be completely up to those parties to decide what they're going to do for their investment strategy. And the reason we like to call this presentation Being the Bank with an IRA is because you really truly are the bank in this case. You do get to determine the amount you're willing to lend, the interest rate, how long you want your money out, is there any equity participation, and when is the payment due, and where is it being paid to. So now it's always going to be paid to the IRA account, but certainly as the lender, if you're checking it off when you receive the check to make sure your payments aren't late, your borrowers can send the payment to you, which you can forward on to the IRA, or the Advanta IRA can receive those checks directly. But you always want to make sure, now going back to disqualified persons, that those checks are always made payable directly to the retirement account. And so, the great thing about being the bank with your IRA is you really do get to determine the rate at which your IRA is going to grow. It's almost like a bank CD with, better collateral if you're doing something like a first mortgage, better returns if you're, if you have a higher interest rate. So there's a lot of advantages to private lending. When you're looking at lending money, consider things like late payment penalties, what happens if there's non-payment, what happens to a non-performing note. There's a lot of things to consider when you're doing private lending. And again, that's the time to engage your professional team, your CPA or your attorney, to talk about those things when you're establishing the note and mortgage so that you're aware of how that process is going to work. So just very simply, benefits of private lending: you get to act as the bank and determine the terms. You're determining the rate at which your IRA is going to grow. Less liability than owning the real estate directly. So many people, even though they might own real estate outside of their IRA, they've sort of made it a business decision, if you will, that they would rather lend money from their IRA than hold real estate in their IRA as well. And if you think about it, if there was a slip and fall or some problem at a property and you were lending money on it, who is the renter or tenant going to call? Are they going to reach out to you or the owner of the property? Well, as the mortgage holder, basically, they're not going to be reaching out to you. And so you're going to have less liability than if you held the real estate directly. So it can be a very low maintenance asset if you have a good payer, they're paying on time, they have a good track record, you're familiar with them, you're comfortable, you've done your due diligence. This can be a very low maintenance asset. And you can partner funds among IRAs and other individuals. So if you're starting out with a contribution, if you're starting out with an old employer plan that had just, $10,000 in it and you wanted to partner funds, even those disqualified individuals that we mentioned, you can partner on investments with. So your IRA and your spouse's IRA can partner into a loan and lend that money out so that you have greater investment power by partnering funds. And I won't go into that too much, but if you have questions on it, please let me know. So now I'm going to go into the case studies to really help you understand how these investments work, what the process is, sort of step by step. And so the first example that I'm going to use is a first mortgage on a property. And this is a very cookie cutter process as far as how it works, because this is something we see on a regular basis. If you are a private money lender, you have probably done this a million times. If you're new to self-directing and you have not lent money yet, but you're looking to, the process is going to be very similar to what you would expect outside of an IRA. The biggest thing is the IRA is the bank or basically funding this transaction. So in our example, Paul has $120,000 in an IRA, and he meets a private mortgage broker who can place IRA funds into a first mortgage to a qualified borrower. Now, in this example, Paul doesn't look for his own borrower, but instead works with somebody who is going to do that on his behalf. But you can certainly do that. And I want to point out, because a lot of times people will say to me, but how do you do that? If I wanted to find my own borrower, how do I do that? And I always suggest looking at your local real estate groups and start networking. And once you start networking and you meet people who want to borrow money, make sure you do your due diligence. Ask around the group, check with your CPA and your attorney on the best way to vet not only your borrower, but the property that that money is going to be tied to. Because remember, in this example, we're talking about a first mortgage on the property. So Paul vets the property and the borrower, and he agrees to loan $120,000. He agrees that the rate will be 8% with a 5-year balloon, and you have a monthly payment of $800, and it is secured by a first mortgage on the property. So he is very excited about that. As far as his security, he feels good and secure in this investment. Remember, he vetted his borrower, but he also vetted the property to make sure that if the borrower doesn't pay, that the investment is a good enough one where he could recoup his investment by foreclosing and taking the property back. So in this example, that's important because he is giving a first mortgage on that property. So he doesn't want to just look at the borrower, but also on the property itself. And again, he engages his professional team to help him with that vetting. A question popped up, is there an interest rate limit on loans from an IRA? It's going to vary state to state based on what is considered usury, and we're going to leave that up to you and your attorney to make sure that you're within the law. The biggest thing is that if you came to us and said, well, I'm going to lend money to this person at a 0% interest, and I don't expect the money to ever get paid back, then we're going to say to you, this doesn't sound like an investment. So there's not a limit to how high you can go, except for based on state law. So you do want to be familiar with that and work with your CPA or attorney there. But if you're looking at something that isn't necessarily considered an investment or for investment purposes, that's when we're going to have questions for you. So we're not really looking at it, if you tell us, well, I'm going to lend it at 5%, but I'm going to get a percentage of the upside, or I'm willing to lend it at 4% because the bank is only paying 2%. Some of these things are going to be completely up to you. You just want to make sure that you're within the state laws and also that you're making investments for investment purposes. So how does this process work for Paul? Well, he's going to open and fund his account with Advanta. That's step number one, is opening the account. And it always is, regardless of the type of investment you're making, you're always going to start out by opening your account. You're going to find and do your due diligence on the loan and the borrower and the property and whatever it is, whatever the investment is. They're going to negotiate the terms and agree. Paul is going to have his attorney prepare the note and mortgage, and Advanta IRA does not prepare any legal documents, so that's important. The biggest thing for us is we're going to look over the note and mortgage to make sure that the IRA is represented as the lender in this case. So we want to see that specific titling that shows that the IRA is the lender. Advanta IRA Services, LLC, for benefit of Paul's IRA number 1234. After we have reviewed to make sure that the IRA is showing its proper vesting, we're going to have Paul read and approve everything. Because remember, we're not doing any due diligence, so we need Paul's approval that he did review the note, he did review the mortgage, he is agreeing upon these terms. And as long as that's true, he'll sign it, and then we will fund that transaction through the retirement account. The mortgage is recorded in the name of the IRA, or with the IRA as the lender, and the investment is complete. The borrower sends monthly interest-only payments to Advanta IRA. And remember, in this example, it was interest only $800 a month. The payment is deposited to Paul's IRA. He can track those monthly payments using online statements. He also gets an email when deposits are made. But if he's worried whether or not his borrower is making those payments on time, remember that we're not a loan servicing company. And so we're not going to chase down the borrower for payments that are missed or late. So it's going to be up to Paul to make sure that those payments are deposited within the amount of time that he expects. And when we receive checks, we simply deposit them. We're not questioning whether they're late or on time or anything like that. So that is going to be Paul's responsibility to make sure that he's tracking those payments. And so if he wants to be a little more hands-on and have the borrower make the payment to the IRA, but send the check to him so that, again, he can check it off and show that it was received in a timely manner, he can then forward that check on to us and we will deposit it. The borrower decides to sell the property 3 years later, and Paul's IRA will receive the $120,000 that he originally loaned upon the sale of the property. So remember, this was an interest-only note. Paul's IRA made $28,800 in interest payments over the course of the loan, and those interest payments will go back to the IRA with no capital gains on the accrued interest. And so that's really important because remember, capital gains don't apply to an IRA. We talked about the two instances where the tax applies, but in this case, this was a passive investment made through the retirement account. And so those payments go back tax-free, and he's ready to make a new investment with the earnings and the principal from that loan. Next, I'm going to talk about the equity partnership or joint venturing, and we do see a lot of this as well. In this example, Andrea has $150,000 in her retirement account that she wants to invest in real estate, but she prefers not to own the real estate, and so she's looking for a deal where she can partner on a rehab of a house. And so in this case, she meets Steve at a local investment group, and Steve has a project that's upcoming. So Andrea says, well, I will look at the property, I'll find out more about Steve, and look at lending him the money. So she's going to do her due diligence on Steve and the property. Steve agrees to use the property for collateral and use some of his own funds as a down payment. Andrea agrees to loan him the rest of the funds. The loan amount includes the funds to purchase and rehab the property. And remember, again, this is just an example. It doesn't have to be that way, but sometimes you do see it that way. And that way, you know, she's basically saying to Steve, well, I want you to have some skin in the game, but I'm willing to lend you X amount of dollars at whatever rate they agree on. So the loan amount in this case is $125,000 with an interest rate of 5%. And remember that, you know, the terms are completely up to you as the bank. So she says 5% is okay because they agree that she'll get a third of the profits when the property is rehabbed and sold. They determine the length of the note will be a 2-year balloon with a monthly payment of $520, and Andrea is happy with the first mortgage on the property. Andrea's attorney will prepare the note and mortgage. Again, she'll approve all of it with her signature saying, these are the terms I'm agreeing on. Please send the money out of my IRA. Advanta will make sure that the IRA is properly represented. And then the Advanta will fund the note. And actually, we do hold the note and mortgage on behalf of the IRA. We do the safekeeping for those recorded instruments. When Steve is ready to sell the property for $200,000, net after closing, he requests a payoff amount from Andrea. Andrea is the loan servicer and provides a loan or provides a payoff letter. And this is important because we don't calculate the payoff. So it's going to be up to Andrea to determine what the payoff is going to be. She sends us a payoff letter for us to sign on behalf of her IRA, and then it will go through the title company or the closing attorney, whoever's handling the deal. And in this case, we always like to go over both the IRA's value and the rehabber's value, and here's why. IRAs tend to be a great way to raise capital, and so if you are doing a lot of rehab projects and you work with private money lenders all the time, and you go to a private money lender and say, hey, I have a property coming up, I could really use a loan, and they say, well, I'd really like to be a participant in that, but all of my money is out right now. Just by knowing about self-directed IRAs, having that tool in your tool belt might be a benefit to you because you could say, well, have you considered lending from your IRA? Many people do not know about self-directing. They are unaware that they can use retirement funds to make these types of investments. And so in this instance, it might have helped Steve to know about retirement funds being allowed as, a first mortgage on the property in this case. And so first, Andrea's IRA's value repaid amount of $125,000. The monthly payments made totaled $3,000. She got a percentage of the upside or of the profits when the property was sold, so there was another $25,000 there, making her total earnings over the course of the investment $28,000. Steve originally borrowed $125,000 and sold the house for $200,000. The repayment of the loan, the profits and interest were $28,000, and so his total earnings were $47,000. So very important to sort of understand both sides of that transaction and see how it could work within any strategies that you use. So non-real estate as collateral, and just a reminder again, guys, please feel free to type any questions into the chat box and we'll get those questions answered. If the note is secured by a prohibited transaction, so let me back up for just a second. So if you're using non-real estate for collateral, there could be a lot of things that are considered non-real estate that you might collateralize for a loan. So something like farm equipment, so like tractors, for example. We've actually seen farm animals used as collateral for loans. So there's a lot of different things that we have seen used instead of real estate. But one unique perspective on that is using something that might be considered prohibited within an IRA as collateral for the loan. But when you look at that investment, what is the investment? Is it the collateral or the loan? Well, it's the loan. And since a loan could also be considered unsecured, well, this investment would be allowed within the IRA. But then you want to look at it from the point of view of if you had to collect on that, if the borrower didn't make payments, what would you do? Well, you couldn't seize that asset if it's considered a prohibited investment because the IRA couldn't hold it. So what would your strategy be in that case to recoup the investment? And it might be something like selling the non-performing note, for example. It could also be distributing the note to yourself prior to collecting. So you have some options, but again, always just sort of thinking ahead on any investments that you're making and doing your due diligence. You also want to look at things like we do see a lot of convertible notes in IRAs. And so if you lend money to a company and it can convert to stock in that company, you want to make sure that first of all, that's going to be something that your IRA can do. Because for example, S corporations can't have IRAs as shareholders. And so if you're lending money to a company and it's an S corp and they want to make that loan convertible, the IRA would not be allowed to be a shareholder. And so you have to think into that investment and on a strategy that might work. You also want to keep in mind that you might be really maybe subject to unrelated business income tax, depending on the investment and the structure of the investment. And then also understanding the use of the security agreement and where it's recorded. So if you're not using a note in mortgage or a note in deed of trust, what does the security agreement look like and how does that work? How is it recorded? And those are all important points to make sure you're aware of and work with your professional team on so that going into this investment, you understand all of your options. So I had a question pop up on if you are a lender. I did talk about networking and finding a borrower, but what if you're a borrower? Where's the best place to find a lender? And that's true in both instances. I always recommend networking. There's a lot of local real estate groups, local to everybody. And I'm not just talking about the Tampa Bay area, but look at your local real estate groups and start networking. That's always the best place, I think, to start. Make sure you're doing your due diligence on anybody you plan on doing business with. Ask around the group. Engage your professional team to make sure that you understand how your relationship will work as borrower versus lender, and ask around, find out who might be the private money lender in the room, for example. But making sure that you understand how it works and those individuals that you're looking at doing business with. But I think networking is always a great way to go. And I think I also mentioned our Pitch, Promote, and Prosper event that we have every other Friday. There are a lot of individuals that join us for those that are looking to lend money. So you're welcome to join us there. And you can always introduce yourself to the group and let people know that you're looking to borrow. We do allow that on that platform. So please feel free to go to advantaira.com /events. Look at June 18th, 2021 for Pitch, Promote, and Prosper, and you can sign up that way. So the next case study we're going to talk about is unsecured lending. And so we're going to talk about lending money in the form of an unsecured note. A lot of times people will ask us about, collateral. A lot of times people talk about real estate as collateral or other items. And I think it always surprises people that there are a lot of people out there willing to lend money unsecured because they either know their borrower personally or they're lending money to a business or whatever it is that makes them feel comfortable with that investment. Unsecured lending does happen. So in this example, Tom has $50,000 in his SEP IRA. He has a friend who wants to expand his business and needs short-term capital. So Tom decides to lend him money from his SEP IRA without collateral tied to that note. Tom drafts the unsecured promissory note listing his IRA as the lender. They agree that he will lend $50,000 at 10% interest. It's a one-year balloon note with a lump sum payment of $55,000. So it's important here that, again, Tom talks to his attorney and makes sure he understands what he can do if his friend should default on this loan. Remember, because it is not tied to real estate, there's no foreclosure action here, so he needs to be aware of what his rights would be for an unsecured note. And ultimately, the money will go out from the IRA to the borrower, and when that payment is made, it'll be one payment of $55,000 back to the IRA and deposited as income, principal and interest really on the IRA. Because there's no title company involved, Advanta does require the original note in our possession prior to funding. And that's very, very important because we cannot release funds until we have the original wet ink signature of the borrower on the note prior to sending the money out. And some people just they're not aware of that. They don't understand why, but remember that the note, the original signed note, is the instrument, and so we do need that on file prior to funding. And we also need Tom's approval that he is agreeing to this loan, and we can always do that through DocuSign, but it's important that we have him sign it as well, saying, yes, I'm okay with money going out in this form. It is unsecured, so it is going to be riskier than conventional mortgages, and the interest rate does tend to be higher. So more risk, more reward is typically the saying, right? And so that usually does apply for an unsecured note as well. Making sure that you do your due diligence on the borrower because it could be difficult to recover if it goes into default. Okay, and before we go on, give me just a minute here. I did have some other questions pop up that I wanted to take a look at and answer. Somebody asked what time the Pitch, Promote, and Prosper meeting is. It's every other Friday at 12 o'clock Eastern time. If you go to advantaira.com/events, you will find it listed there. You do have to register. That's very important. So click on the link, make sure you register, and then you will receive the link to join. It is on Zoom. We do not put borrowers and lenders together. So I had somebody ask me that. In the instance of our Pitch, Promote, and Prosper meeting, we allow people to network, but we are not putting borrowers and lenders together, and we are also not vetting any borrowers versus lenders. And so it's going to be up to you to make sure you understand any individuals that you're doing business with. And so, outside of networking, we can't, say, oh, here's people looking to lend money from their IRA. We absolutely cannot do that for compliance purposes. And yes, I am going to talk about IRAs borrowing money. Actually, that's the next thing we're going to talk about. So I had a question about that. I had a question about the loan amount being based on the amount of cash in the IRA, or can it be based on other assets in your account? It's typically either going to be cash in the account or cash in the account plus partnering. So again, IRAs partnering together. So it could be my IRA and my husband's IRA partnering. We might own the loan 50-50 based on the amount of funds we each bring to the table for the loan, and then we receive the income based on our percentage of ownership, for example. Go ahead and give me a call after the webinar and we can go into this in more depth because I'm not sure outside of that I understand your question. Okay, so let's move on. I appreciate the questions. Thank you so much, guys. Keep them coming. So let's go over how an IRA can borrow and what moving parts there are within the retirement account when an IRA borrows for real estate. We have just a couple minutes here, and this is our last example, so we'll go through this and help you understand how it works. So Mike has a 401k with 160,000, and he finds a house for 150,000 that doesn't need repair work. But he doesn't want to use 100% of the IRA funds, and he would also be short in this instance. So he works with a lender who is willing to give him money if he puts $60,000 down on the property, and he will be able to finance the rest. He has to work with a non-recourse lender. That could be seller financing, it could be private money, it could be institutional, but it has to be non-recourse, keeping in mind that for the IRA's purpose, you can't extend your personal credit or give a personal guarantee. So what is a non-recourse loan? That very simply means that the lender can only foreclose and take the property back. They can't come after you personally. So again, it can be seller financing, private money, institutional funds, whatever it is, it just has to have that non-recourse language in there. So in this example, Mike borrows $90,000. He puts down 60. The interest rate is 6% over 30 years, and he has a monthly payment of $540. The annual payments come to $6,500, and this is important because the loan is to the IRA, so keep that in mind. Mike isn't going out there and getting a personal loan for this investment. The loan is to the IRA, non-recourse fashion, and so the IRA is responsible for making those monthly payments, and that's very important. So what does that look like? Well, again, Mike cannot guarantee the note personally, so the bank can only foreclose on the IRA and take the property back. The IRA pays the loan. The lenders for non-recourse usually want 30 to 40% down. They are going to look specifically at the property. Institutional lenders are typically not going to do something where they're lending on rehab properties. It's going to be long-term rentals usually, but you can always shop that. You never know. Income received on the mortgage real estate is subject to unrelated business income tax. So remember, we talked about this tax. I mentioned when you have an IRA that borrows to make an investment, there are going to be some moving parts. Moving part number one, the loan has to be non-recourse. Number two, income on the amount of debt is going to be taxable under UBIT rules, so unrelated business income tax. And basically the way that it works is if you borrow 50%, let's say, then 50% of your income is going to be taxable based on UBIT. That 50% of the income annually is going to be taxed at trust tax rates, which I think it's 37 or 39%. It is high, but this is the only scenario where the IRA does get to take deductions. And so it's going to get some deductions in there. You're going to work with your CPA to learn about the deductions, calculate the tax, file that additional form called a 990T, and the IRA will be responsible for paying that tax on an annual basis. I had a question pop up. Does it apply to a Roth IRA? It does. I know the Roth IRA is famous for being tax-free, but this still does apply to a Roth IRA. It does not apply to a 401k as long as the purchase is made with financing, and there's some rules that go along with that, but the only qualified plan that this does not apply to, or it is basically a qualified employer's plan or a 401k. So if it ends in IRA, it's going to definitely apply. It applies to an HSA and an ESA. It does not apply, for example, to a solo 401k. But the 990T is filed by your tax professional, but the tax itself is paid by the IRA, and I have an example of how that is calculated. So here in our example, the monthly rent is $2,000. The loan payments are $6,500 annually. The expenses are listed here. Net prior to paying the tax, as you can see, with financing would be $11,500, and then we compared it here on the right side to an all-cash purchase of $18,000. Net income subject to UDFI is going to be $6,900. And also I want to clarify, UDFI, or unrelated debt financed income tax, it's really the income that triggers UBIT. Sometimes those are used interchangeably, so if you're doing research on it, you'll find both unrelated business income tax and unrelated debt finance income tax, and they're sort of used interchangeably a lot of times because of that, but that's what they're talking about. UDFI tax is 28%. In our example, we did not include deductions. So remember, I talked about getting depreciation and deductions and working with your CPA on those calculations. Then, in this case, you would pay less in tax ultimately. It would result in paying less in tax over the course of that year. So, again, it doesn't include it in. So your income minus the taxes in the example where you had financing is $9,568. In the column where we show an all cash purchase, you can see that it is substantially more. However, we always suggest, if you're thinking about buying with financing, that you are looking at you're talking to your CPA and determining whether or not it's a good fit for you, because there are some advantages of buying with financing. For example, you get to have greater buying power. So in this example, Mike would not have been able to make the investment that he wanted to make if he didn't finance, because he didn't have enough money in his IRA. Now, you can always partner funds. Remember, we talked about that. He could always make an annual contribution as long as he was eligible to, although if he had a Roth IRA or traditional IRA in this case, he would not have been able to contribute enough to cover the total purchase. And so in his case, he appreciated the fact that he could do the financing and have greater buying power. As you pay down the loan, you're going to owe less and less in tax every year. And after the loan has been paid for 12 months, the tax will no longer apply. So I hope that helps you understand the purchasing real estate with financing. And I know it can, like I said, there's a lot of moving parts. A lot of times people ask me about financing, but they tend to shy away from it based on the amount of moving parts and with, advice from their CPA. But it is a strategy that we see used from time to time. So how do you get started with Advanta? It's really easy. You fill out the application. You can do it online. It only takes a couple of minutes. And then we pair you with your own account manager who will guide you through every step of the way. You can fund with a contribution. You can transfer funds or move funds over from an old employer plan. And then you're ready to start investing. And a lot of times people come to us with an investment in mind already, and that's okay too. We can try to work within your timeline. What usually takes the longest is very simply moving funds, and we're sort of at the mercy of the other custodian once we request the funds. And so dependent upon how quickly they can move the funds, we could still make your investment in just a week or two, as long as they are willing to cooperate. So if you have an investment in mind and you're looking to get started right away, please reach out to me and we can go over how that works. Here's my contact information. Again, I had a few requests for the slides. Please go ahead and email me. I request that you send out an email over to me because I don't get the information right away from the chat box. So if you could send me a quick email, Greene with an E on the end at advantaira.com, and I will get these slides out to you. I did have a question on fees, and I'd be happy to go over that with you. If you want to give me a call or send me an email, but essentially it's $295 per year per asset, and we pay expenses, receive the income, and do your IRS reporting for that fee. But when you're doing private lending, I have another option on the fee schedule where it could make more sense for you to go with that second option. So it really just depends on what your strategy is and where you can save on fees. So again, my contact information is up here. If you'd like the slides, please go ahead and send me a quick email and I will get them out to you. And let me just look at the questions real quick. I wanted to I just wanted to review the questions and make sure I answered them all. I did have a question on whether or not the UBIT applies to just lending money. Not typically. When you're lending money, you're in a passive role typically. You're going to be receiving interest income to your IRA. The two instances where we talked about the tax applying would be if you were running a business out of your IRA, or receiving business income, or when you're actually borrowing to make an investment. So an investment into real estate, for example, which is what we just kind of went over. So typically you're not going to have UBIT apply for private lending only. I had some more questions about the fees. It's really dependent upon the structure and strategy that you're using, but and I'd be happy to go over that with you. Please send me an email and I can send you our fee schedule, and also we can talk about what your strategy is going to be. Again, if you're doing short-term lending, for example, I have another option based on the value of the account where you could definitely save on fees. But the first option is $295 per year per asset. The $295 is regardless of the value of that asset, and it includes us receiving the income, paying any expenses, and doing your IRS reporting. But please reach out to me because I'd be happy to go over that with you, and we can go in more detail over your strategy and which option makes sense for you. And the other thing that I want to mention as well is that a lot of our lenders will recoup our fees through their borrowers. So they may charge the borrower directly, they may charge points to include any additional fees. And so sometimes we see Advanta fees right on the loan paperwork as an expense to the borrower, and you certainly can do that as well. So there's a lot of different options available to you that we see people use as strategies all the time. Thank you so much, everybody, for joining us, and I hope to talk to you all soon. Again, send me an email if you would like those slides. I'd be happy to get them over to you. This is recorded, and you will receive a link to the recording in just a day or two, so you are welcome to review it or share it, and I'd love to get some feedback from you. Thank you for your time.